Very good morning to you all.
Good morning.
Good
Good
morning.
morning,
Good
sir.
morning, sir.
Right. We'll start the second session. Thank you for
Morning, sir.
joining early in the morning. I think when you join, when you start your work early, not early here, right? 7 means not that much early, but on a Sunday, some might think 7 a.m. is a bit early. But for the benefit of everyone, I decided to have this session starting at 7 a.m. Thank you for joining. Right. What we have discussed last week, I emphasized the matter that as credit managers, the knowledge of accounting for a banker, especially for a credit manager, credit officer, relationship manager, is becoming more and more important than forever. Last week we had a bit of introduction on the accounting. I think I got good feedback from bulk of you, and they especially thanked me on the fact that they were nothing on some parts of accounting, and after that lecture they were largely benefited, and they want to continue the that starting point, and same can be applied for the exam. And today the second session will be allocated for some theoretical aspect in your course model. If you do have any questions what we discussed last week, you can raise. Otherwise, we'll go to the today's proceedings. If you do have any questions that we discussed last week. The foundation and the basis is that we put on last week. We can build pillars here today. It's very important you participated all the 4 sessions. Otherwise, the question paper purely based on the sessions and the content of the sessions that we conducted, and very straightforward question. Right. Okay. We'll then move on to the today's one. I'll share the slides. Hope you can see the slides.
Yes, sir.
Right. Thank you. Right. Under financial statement analysis, now a bit of accounting, not only the a small part, we actually covered considerable amount relation to accounting last week. Now you have a good understanding about what is an asset, liability, income, expenses, equity items, the kind of entities we have, and how financial statements are prepared, the component of financial statements. If I give a bit of introduction about today's topic, now I last week discussed loans and advances are the biggest asset in the bank balance sheet, right? Comparatively, banks' balance sheets are material or very huge compared to other entities. Normally, if you take an entity, an asset can be acquired via 2 ways. For a company to acquire asset, there should be some funds. the source of funds can be normal in a normal business, can be of two ways. That is, owners can put their money, or else they have to go for a borrowing, right? As for a borrowing or external funding, that is liability. But in case of a bank, we have one additional thing, that is, apart from the owner's money, apart from the borrowings, we have what is called asking for deposits, right? Banks have the rights to ask for deposit from the general public. That's why we have huge balance sheet. To take our equity and the liability part, as I mentioned, if you take asset part, 90% of the assets are loans and advances. Similarly, if you go to the other side of the balance sheet, that is liability and equity, if you take total, 90% represent from the deposits. Owners put about 5 to 10% of the total equity and liabilities. We have some small borrowings, but largely the other side represents deposit from customers. Therefore, normally we say banks doing business of finance, where you take money from the depositors and lend it to customers, right? And we take a margin. We borrow or we take deposit at say 5%, and we lend at 9%. We have a margin of 4%, right? In today's context, the margins have contracted comparatively those days because the lending and the borrowing rates are reduced. Now there is a trend of increasing since we talk about opening of country and getting more and more business. There can be demand for loans. Now, if you take this last 2 years, almost 2 years, we have excess liquidity in banks' balance sheet. We have more deposit, rather very low lending or no lending, right? Similarly, from this course, we aimed at the lending part, that is asset side of the balance sheet. In a lending, you create an exposure which normally associate with kind of a risk present as well as future. If you don't get the future proceedings expected from a customer, you may lose bank's money. That is a loss of capital and profits. Therefore, the lending decision is very important, right? You are exposing our customer deposits, right? I said 90% of the assets are loans. 90% of the other side of the balance sheet is represented by deposit. Therefore, normally when you lend, the 90% of the lendings are based on customer deposits. Therefore, it's very important that you take the correct decision. That's why there is a separate entity called Central Bank of Sri Lanka. We have separate ratios to maintain, namely SRR, liquidity ratio. Then there is another ratio, set of ratios called capital adequacy ratio, tier 1, tier 2. Those kind of ratios are there. Because our exposure, we take our exposure using customers' deposits, right? Therefore, when you are dealing with others' money, there should be a kind of a discipline, a financial discipline to be adopted, and some independent organization have to monitor that discipline. Then point number 2, the risk assessment and the management, the kind of a key skills of a successful lending and in banking operations. Therefore, we have to have a good, skillful person, especially the branch managers, credit officers, credit managers, relationship managers. Those people should be in a position to assess the correct amount of risk before you disperse a facility to a customer. Right. Then lenders involved with the review and sanctioning process of the credit have a primary objective of assessing risk involved with the view to minimize losses. The same point I have emphasized again. What our lenders in the sense in a bank, normally lenders means our branch managers, credit managers, and relationship managers. Here the in a large picture, it is the bank who play the role of a lender. There should be a clear process of assessing the risk involved. And point number 4, for this assessment, you need to have a proper credit analysis via accounting techniques and plus other factors taken into account before you conclude a final lending decision in a lending process. Right. That's why we started the session with the topic financial statement analysis. By and large, you are expected to do a financial statement analysis. Right. In that process, you need to know the things in the financial statements, the formats, everything, and the items we have already discussed. There can be 5 items incorporated in the financial statements, namely asset and liability, income and expenditure, and equity, and the substance of each item in the financial statements. We have already discussed this thing. If you take a set of financial statements according to LKS 1, LKS 1 means Lanka Accounting Standard 1, LKAS means Lanka Accounting Standards. It says the purpose of preparing the financial statements is to give 3 set of information. One is, if you do want to write down anything, you can take down, right? Everything cannot be given in a note, but if you feel free, you're free to write down anything. If you feel this is very important, you can write down. Now, according to this LKS 1, it says the purpose of preparing and presenting the financial statements is for you have set of people who are interested in going through these financial statements. Namely, last week we discussed, namely owners, lenders, managers, government, especially in the department, your customers and your employees, various research analysis. Likewise, there are a set of people who are very much potential investors interested in seeing or going through in this set of financial statements. The main objective of preparing the financial statements is to give 3 things. Number 1, you have to give the financial performance of the company, right? The financial performance in the sense you have to give whether the company is in a profit or loss position. Normally, out of the financial statements, this financial performance will be represented by the income statement or comprehensive income statement. It will give the whether company is in a profit position or loss position, the income and expenditure, the detail, everything is given. Then number 2 requirement needs to give the position, financial position of the company. First one is the financial performance. Second one is the financial position. Right? If you take this word position in the sense you have to give the details of assets, liabilities, and equity items. Details of assets, liability, and equity items. Normally, the details relating to financial position will be provided by through the statement of financial position, or the balance sheet. Then third requirement or third objective, preparing financial statement to give details on the cash flows. Very important statement. That is given through statement of cash flow or cash flow statement. That's why the first 3 statements will largely represent the components of the set of financial statements. Right? According to LKS 1, the objective of preparing financial statements to give the interested party the details on financial performance, financial position, and the cash flows to take economic decisions. Right? That's why we prepare the financial statements. If you are not preparing for that purpose, the financial statements, there is no meaning to prepare the set of financial statements. As I mentioned last week, there are 6 components to take a set of financial statements. That is income statement or the comprehensive income statement. Comprehensive income statement have 2 parts, income statement plus the other comprehensive income statements. Then statement of financial position, then cash flow statement, statement of changes in equity, accounting policies and accounting notes. Income statement gives the financial performance, that is profit or loss. Then statement of financial position will give the details related to financial position, that is on assets, liabilities, and equity items. Then cash flow will give about the cash flow position of the entity. Then statement of changes in equity, what are the changes you made in the equity statement, we'll go into details. Then accounting policies, the policies based on which you prepare the financial statements. For example, you take the depreciation policy for motor vehicle, one company may have use reducing balance method, or one company may use straight line method. Similarly, if you take the same example, you take the straightforward straight line method, one company may take 10% depreciation rate, another company may take 5% for motor vehicles. That is their policy. You have to disclose along with the financial statements. Then the reader can get a good understanding on the financials. That's why there is a requirement to declare the accounting policies based on which you prepare the financial statements. Similarly, accounting notes. On the face, there can be a lot of items in the main 3 statements. If you want to give details, you can have a accounting note for that item. Any questions up to now? Any questions? If you do have any questions, you can clear it now before I go to the next part. මොන හරි ප්‍රශ්න තියෙනවා නම් අහන්න පුළුවන්. අහලා ක්ලියර් කරගන්න. Right, okay.
Sir,
Yes.
statement of financial position එකෙන් අපි මේ details of financial performance මේවා කරනවා කියලා කිව්වේ?
නෑ. අපි main statement තුනක් තියෙනවා. එකක් තමයි income statement. Income statement එකෙන් තමයි financial performance. අපි දැන් ඔය LKS fund වල define කරනවා ඇයි අපි financial statements හදන්නේ කියලා. financial statements හදන්න ඕනේ objective එක තමයි. එහෙම නැත්නම් පරමාර්ථය තමයි financial statements හදන්නේ කාරණා තුනකට. එකක් තමයි අපේ financial statements පිළිබඳව interested parties ඉන්නවා. ඒවා අපි ගිය සතියේ ඩිස්කස් කරා. මතක නම් අපේ ආයතනයේ ඕනර්ස්ලා, මැනේජර්ස්ලා, තව අනාගත ආයෝජකයෝ, ඊළඟට අපේ ආයතනයේ ගනුදෙනුකරු, අපේ ආයතනයේ සේවකයෝ, වෘත්තීය සමිති, රජයේ විශේෂයෙන් ඉන්ලන්ඩ් ඩිපාර්ට්මන්ට් එක, ඊළඟට අපිට ණය දෙන්න බලාගෙන ඉන්න කට්ටිය, ඔය වගේ interested parties ඉන්නවා. එතකොට අන්නේ interested parties වලට කාරණා තුනක් දැනගන්න අවශ්‍යයි. ඒගොල්ලෝගේ තීරණ ගන්න ඉස්සෙල්ලා. එක, මේ ආයතනයේ financial performance එක පිළිබඳ විස්තර දැනගන්න ඕනේ. ඒ කියන්නේ මේ ආයතනයේ ලාභයක් තියෙනවද අලාභයක්ද තියෙන්නේ. ඒ financial performance පිළිබඳ තොරතුරු දෙන්නේ income statement එකේ. මොකද අපේ ආදායම් වියදම් ටිකනේ income statement එකට යන්නේ. ඒක තමයි ලාභය හෝ අලාභය හදන්නේ. ඊළඟට තව අර තොරතුරු දැනගන්න බලාගෙන ඉන්න කට්ටියට තව තොරතුරක් ඕනේ. ඒ තමයි financial position එක පිළිබඳ තොරතුරු. ඒ financial position කියලා කිව්වම හැම වෙලාවෙම අපි කතා කරන්නේ asset, liability and equity. වත්කම්, වගකීම් සහ හිමිකම් කියන ශේෂයන් සම්බන්ධයෙන්. එතකොට අපේ financial statements ගැන interested parties වලට දැනගන්න ඕනේ මේ ආයතනයේ එක පැත්ත financial performance අනිත් එක financial position. මොනවාද තියෙන වත්කම්, මොනවාද වගකීම් තියෙන්නේ, මොනවාද හිමිකම් තියෙන්නේ. ඒක තමයි දෙවෙනි කාරණේ. තුන්වෙනි කාරණේ තමයි cash flow පිළිබඳ දැනගන්න ඕනේ. මේ ආයතනයේ මුදල් තියෙනවද? නැත්නම් profit විතරද තියෙන්නේ, මුදල් විතරද තියෙන්නේ? දෙකකින් ඕන එක. සමහර ආයතනවල profit තියෙනවා හැබැයි මුදල් නැහැ. මොනවාද එන මුදල් ප්‍රවාහ? ඒව කොහෙටද වීදම් කරලා තියෙන්නේ? ඒතර ඒක දෙන්නේ මුදල් ප්‍රවාහ ප්‍රකාශයෙන් නැත්නම් cash flow statement එකේ. ඒතර ඔන්න ඔය කාරණා තුල පිළිබඳව තොරතුරු සපයන එක තමයි financial statements හදන එකේ පරමාර්ථය වෙන්න ඕනේ. කාටද අපි ආයතන පිළිබඳ interested parties වලට. ඒතර ඔයගේ ප්‍රශ්නේ හැගේ financial performance පිළිබඳ තොරතුරු අපි දෙන්නේ අපේ income statement එකේ. හරිද?
Yes, sir. Thank you.
Right. තව වෙන ප්‍රශ්න තියෙනවද? Right. Okay. ඔයගොල්ලන්ට ඒ මයික් එක ඔන් කරලා අහන්න බැන්න ටෙක්ස්ට් කරත් කමන්නේ ඕනේ කෙනෙක්ට මම බලනවා මේ සැරින් සැරේට. දැන් මම කොහොම සැරින් සැරේට බලනවා මේක අර ඔන්ලයින් එකකින් එකපාරටම මේ ඩිස්කනෙක්ට් වෙන්න පුළුවන් හින්දා මම කොහොම සැරින් සැරේට බලනවා. Right. If you do not have any other questions, we'll proceed. As I mentioned earlier, there are 6 components in a set of financial statements: income statement, statement of financial position, cash flow statement, statement of changes in equity, accounting policies and accounting notes. Even a proprietorship, partnership, company, any entity should prepare that set of financial statements, right? You should ask for a financial statement, then the client should provide the financial statement including those 6 components, right? Not only the income and income statement and the balance sheet. Right. Then you have business clients in Sri Lanka. You have different types of business clients. namely individuals. There are individuals who come for a lending facility. Then sole proprietorships, ඒකපුද්ගල ව්‍යාපාර කියලා. Then you have partnerships, normally governed by 1890 Partnership Ordinance. Partnership ආඥාපනතේ, අවුල් ව්‍යාපාර ආඥාපනතේ 1890. Then you have companies. When it's company, a small scale company, you call normally a private limited company. Then you have a kind of a public limited company, even a listed company. Then other categories such as associations, clubs, then others. In the exam, normally we focus on financial statement analysis of a company, right? Then things that you worried when analyzing the financial statements of different individuals or category of business. You take the first category, there are no financial statements, right? There are no financial statements. Now, if I ask questions, what are the two main factors you take into account before disbursing a facility? Two main factors you normally take into account along with other factors. What are the two main factors before you making a credit decision? You have a lot of things to analyze and take a decision, but you take these two factors very important, very seriously before you making a credit decisions. You can name those two factors. What are those two factors? Can you give me answers? For every credit facility, you take these two factors as the most important two factors. I can see the correct answer also. Very good. Now, most important thing is, when I ask a question, you have to give your answer in your mind, right? No one find that you have given a wrong answer, right? But what is important there, right? When you try to give your answer at the exam, you will get failed. Right? Here in the classroom, you can make any number of mistakes. You won't get failed, but you will be corrected yourself. But when you are first time giving answers at the exam, if it is correct, the answer is correct, no worries, you will pass. But if it is wrong, there can be problems. You have to again sit for the exam, right? Good bulk of the people have given the correct answer. The correct answer is, first one is the repayment capacity, whether the client is in a position to repay the principal or the capital amount plus the interest. Then the second one, that is in case of the loan being performing, very active loan is in a good condition, you are worried about the repayment capacity. right? It will reassess how well you have assessed the client's repayment capacity. Is an assessment when the loan is in a good one. When it is bad, when loan become bad, your assessment on what will check? Your assessment on collateral or the security, right? Whether you have correctly assessed the security, right? Therefore, along with other conditions, there are mainly two factors. That is, one is the repayment capacity. Second one is we have to worry about the security. In case if the loan becomes bad one day, what will happen to the bank? How it will get recovered? Then you worried about the security. Therefore, normally we say if a loan in good category, that is your assessment on the repayment capacity will be checked. If it is bad, then no need to worry about this repayment capacity because that is no more valid. You failed on the repayment capacity, that's why a loan became bad. Then your assessment on security will come on to light, right? Therefore, the two things that you need to worry is repayment capacity plus the collateral or the security. We'll move on. Therefore, in this slide, especially if you take these sessions, I am talking about the repayment capacity. I am not talking about the securities that you take for loans and advances. That is more or less relating to recoveries, legal aspects, those things, right? But we, in this particular model, what we worried about is the assessment of repayment capacity, very correctly. Assessment of repayment capacity, whether this particular client or the individual can repay the principal and the interest in future. Therefore, if you take individual, the credit facilities to individual will normally be considered based on their income, wealth, standing in the society, etc. Tax payment conducts of bank account will be viewed as evidence of income. If it is a salary employed, you can ask for a salary receipt. Say there is no business, but an individual is doing kind of a his own kind of a activity. In that case, you should ask first that individual to deposit some money regularly on a bank account in order to assess the particular income. There should be a kind of a way for you to assess the income of that individual if there is no proper salary slip. Right. In case of a sole proprietorship, very small scale business, credit facilities considered can be similar to individuals. Income will be based on business profit. You can ask for a business registration number. Tax payments, conduct of bank account, viewed as evidence of proof of business income, right? Say you have your this particular person, you cut your hair. In that case, that individual, you should ask that person to deposit money regularly in the bank account, assess the income. Then partnership business, somewhat larger than proprietorship. Very important that you need to take the partnership agreement, because according to Partnership Ordinance 1890, a partnership can be started or commenced by way of in writing or by way word of mouth, and there is another method called implied, right? We as bankers, we cannot take those two items, that is by way of word of mouth and implied. You have to take the partnership agreements, right? The details in the partnership agreement will resolve a lot of ambiguity when it comes to a facility became bad. Therefore, it is very important. If you do not have that particular partnership, do not have a partnership agreement, ask them to draft a partnership agreement and get it signed by all partners. Partnership business comes under the legal framework of Partnership Ordinance 1890. Partnership agreement is a very important document to examine before considering credit facilities. Business registration, tax payment, conduct of bank account will be viewed as evidence of proof of business income. In the event of legal action against partnership, action should be filed joint and several liability, because in case of sole proprietorship and partnerships, there is no legal entity, right? Even for tax payment, individual partners or the individuals will have to pay taxes on behalf of the partnership or the proprietorship, since there is no legal entity. Then when it's come to company, the Company Act is number 7 of 2007, effective from 3rd May 2007. This is no more a new act, almost 14 years expired now. Compared to proprietorships and partnerships, very you know these things. The company has a legal entity, identity. Then liability of members will become limited to the extent of capital that they contributed to the company, and there is no limitation for number of shareholders as far as the company is concerned. Therefore, you can publicly, if it is a public company, you can ask general public to contribute for the capital. Now, these days, you can see a lot of IPOs, initial public offerings, because when it comes to normal public, the deposit rates are very low. In that case, they normally go for long-term investments such as debenture shares, right? Share market now become more efficient and effective, and a lot of gains are there. And indices also have reached their maximum levels. In a company, you can ask general public to contribute capital. There is no restriction as far as the number of shareholders is concerned. Therefore, very that is a kind of a benefit for a company compared to a sole proprietor and a partnership. These are some features of a company. Important features. Now, previously Act, that is number 17 of 1982, then when this particular new Act introduced after nearly about 25 years, there were some changes. The concept of par value or nominal value of share capital was there according to the previous Act. Now they have taken off that concept. Now in those days, a share, there is par value called for a share, that is 10 rupee or 100 rupee or 1000 rupee. That concept they have taken it out. Now there is only an issue price, no par value, only issue price. The issue price can be of any number. For some companies, it can be 15. In some companies, it can be 10. For some companies, it can be 17 even. Then the term previously used as share capital, now we call the share capital as stated capital, right? In a proprietorship, you can see the capital account. In a partnership, you can see capital and current accounts. But in a company, the equity part will get represented by this capital, that is stated capital. And in a company, not only the stated capital, you have another thing, that is undistributed profits, reserves, right? We have already discussed last week. Equity of a company will get represented by stated capital plus the reserves. Then what in the previous act, there were two main documents, that is memorandum of article association and the articles of associations. And the memorandum was to describe the objectives of the company, whereas articles have described the powers and everything of a company. Then this particular new act, 2007 Act, they have abolished the document called Memorandum of Association. You can only have the Articles of Association. There is no requirement to have a Memorandum of Associations. That's because in previous Act, if a company defined some areas of business, it was limited to that area. If a company want to go to another area, they want to change their memorandum. Now, according to the new act, there is no specific area, there is no restriction for a company to conduct their business for a specific area. Therefore, any company do any type of business in any area that they want. Therefore, the purpose of having a memorandum was abolished in the new act. Then there is a concept called authorized capital in the previous act, whereas in the new act, that concept they have taken off. No need to define your maximum capital levels. There is no limit in the issued capital. I have already discussed point number 4, no limitation on business activity of the company. That's why they have taken off the memorandum. Then number 5, Articles of Association provides the details of the company and also the rules and regulation governing the activities of the company. The same thing, nothing was changed in respect of these Articles of Association. Then first schedules of the Companies Act, there are schedules in the act. Every act, last pages provide the different schedules. The first schedule of the Companies Act provides a model set of articles which may be adopted or amended as appropriate. When you want to form a company, you can go through the first schedule of the Companies Act. There is a kind of a format for an article. You can use that format, or you can have amended format using that format. Any questions up to now? Do we have any questions? Today's lecture, a kind of a theory part, but there are some discussions. Definitely you will get involved, right? If you do have any questions, you can ask. Otherwise, I can proceed. No questions? Can you explain what a memorandum? Memorandum for there are 2 items. in the previous act, according to the previous act, that is 1982, number 17 of Company Act, for a company to establish, there were two documents you have to provide to the register of companies. Those two items, that is memorandum of association and articles of association. In the memorandum of association, you have to define your objectives and area of scope. What are the business you are engaging? But when it comes to the second document, that is articles of association, it provides the details of the company and the rules and regulations govern the activities of the company. Now, when come this new act 2007 number 7, they take off the requirement of submitting this memorandum of association mainly due to there is no restriction on the activities conducted by a company. In the previous act, when you provide a memorandum of association, you have to confine your business activities to the things that you stated in the memorandum of association. For example, say if you are define your business activities as tea plantation and tea production and exportation, if you want to expand your business activities to different things, say coconut plantation, you have to go and amend the memorandum of association again to do that. But in case of a new company act, all the companies, there are no any restrictions, no limitation on business activities of the company. Any company do any business activities. Therefore, no need to provide a memorandum of associations. That is no longer a valid document to be provided to the register of companies to incorporate a company. You need only the articles of association, which provides the details of the company and also the rules and regulations governing the business activities of the company. Any other questions? In the this particular model, you will not be checked with these legal aspects. I hope that there are another models in the certificate course, but mainly focusing on the financial statement analysis. But here and there, the theoretical aspects will get touched in the exam, but the majority part will be checked with the financial statements of analysis. So what about clubs and societies? Clubs and societies, what do you mean? In case of clubs and societies, even clubs and society, if they come for a facility, you need to assess the repayment capacity and the security, right? For a clubs and society, there should be a set of financial statements audited by a chartered accountant or a qualified auditor. We have to get those things and evaluate the repayment capacity. And if you want to take some securities, also you have to take the securities. Right. If there are any age analysis on providing facilities to business entities, minimum of business conduct years for consideration. I don't understand. Do you have a question? If there are any age analysis on providing facilities to business entities? Minimum of business conduct years for consideration. Dilepan, I'm not clear about what you stated in the text.
Sir, this is Dilepan.
Yes.
Sir, this is regarding that when we are considering or providing loan for customers, for business entities especially, is there any age like if this customer should be minimum of 5 years or 10 years in business? So on those of conditions we have to watch when we are providing loans.
Yes, yes. There are a lot of things you have to conduct, you have to take into account before you disperse or before you conclude a credit decision. But I was talking about the main two aspects, that is repayment capacity plus the security. Apart from those two conditions, even though there are repayment capacity and proper securities available, still you may not take that credit facility due to other factors, right? There are a list of other factors you have to worry, but in this model, we are mainly focusing on the assessment of repayment capacity. How do you assess the repayment capacity before you disburse a credit facility? You are correct. Those are other conditions you have to take into account before you, and there should be some standardization. There should be, when it comes to different sectors, you might have different sector classification in your corporate field, and different sectors may have different ratios, different understanding. This is also kind of a thing you take into account before you dispersing a facility. But main two things are assessment of repayment capacity and the security. So why they had changed the articles of association in such a manner? How can we monitor the specific business activities done by the company in that case? I think why they have changed that decision to have more flexibility in a small country like Sri Lanka, there should not be any restriction. Now, normally, anything can be written in the documents, but as credit managers, when you lend, you have to visit and you have to take the financial statements. It will get reflected the all the business activities that they do. Otherwise, something written in a document, you cannot rely 100% on that. But the real purpose, I think, for my knowledge, I think business entities, they have given very flexibility in conducting business. That's why they have changed that memorandum of association. Right, any other questions? Right, we'll proceed. These are the types of companies. You have limited liability companies. You have unlimited liability companies. Very rare you can find those companies, even though in the Company Act they have given these kind of provisions, but in 100% of the companies registered in the Sri Lanka, limited liability companies, and there are some companies limited by guarantee. In that case, specific guarantee amount should be specified. Those are more or less relating to a legal aspect of a company. I am not going to check on these things. You have to go through the Company Act. You have to ask for if there is a legal module in the this particular course. You have to ask those things and check with those particular lecturers. And in case of one single shareholder company, there is also provision is available for government institute. Secretary to the Treasury on behalf of the government has powers to incorporate single shareholder company, and that is a special thing under Section 39. You can have that thing. Then under Section 49 talks about the different classes of the shares. Now, in a proprietorship, the single owner will provide the entire capital. In case of partnership, the partners will have to provide the capital, and the equity part will get represented through capital and current accounts of the partnership. But in case of share company, you have stated capital. In order to raise the stated capital, there is a separate instrument called share, right? You have to issue shares to the prospective buyers of shares, and the person who get the shares called shareholder. Until a proper allotment is made, that particular person will become an applicant. But after allotment of shares, that particular applicant thereafter be called as shareholder. In a small company, there can be a limited number of shareholders, like 5, 10, right? But in a listed company, where shares are listed in a share market like Colombo Stock Exchange, in Sri Lanka only one share market is there. But if you take other countries like USA, UK, even Japan, there are different stock exchanges available. But in Sri Lanka, there is only one stock exchange. If you want, you can list your shares in the stock exchange. There are a set of rules and regulations before and after you registered your shares with the stock exchange. In that case, your share has a market value. There is a market for your share to buy or sell. It will be decided on the market conditions, the supply and the demand for your share. And in that case, when your shares is listed, any person can become, even though you were the person who incorporate the company, but after you listed your shares in the Colombo Stock Exchange, the ownership of the original owner can be taken off. There are a lot of instances where after you listed your shares in the CAC, the original owner has less than 50%, and there is a new owner who has more than 50% of that company and becoming the major shareholder of that company. And the original person who incorporated the company also loses their seat in the board of directors. Therefore, the Section 49, it says different classes of shares. You normally find these ordinary shares and the preference shares. I do not want to go into detail in this aspect, just for your reading and understanding. I will just read out. No share will have a nominal or par value, Section 49(4). Now, we need not to talk about the nominal value or par value, since now it has abolished now after 2007, almost now 14 years gone. Shares in a company shall be transferred in the manner provided in the article, Section 49(5). If there is no restriction on the transfer of shares, it is termed a public company. such company should use the public limited company PLC along with their name, right? You have to demarcate even a public company. If it is not listed with the share market, it is not a listed company. But there are now, even though you incorporate that company as a public company, in order to get a market value, you have to list your shares in the share market, right? If it is listed only, you can attract more shareholders or more potential buyers for your company shares, right? Same topic continue. Shares in a market company. If a company prohibits offering shares to public, section 27A, then it is termed as a private company. Such company should use private company limited or PVT limited along with their name. These companies are called small type of companies. Normally, if you listed your company as a public limited company or a PLC, normally you get registered in the share market. Otherwise, the attraction, right? The option to go for a public will be limited because once the public acquire your shares, if they want to sell those shares in the market, if you have not registered that share in the share market, the liquidation of the share will be of useless. In that case, normally the public companies, if they won't go for a public issue, they first initially registered with the or listed their shares in the share market. Then thereafter, they will issue the public offering. Shares may be issued for cash or consideration as decided by the board. Normal way is issuing shares for cash. Other consideration very rarely looked at, but normally it will be done based on a return for cash. Where shares are issued for consideration other than cash, the board of directors shall determine the cash value of such consideration for the above purposes and take that into accounting, calculating the stated capital. That is a kind of a complex process. I do not want to go into detail. Now, this is very important, accounting records. Do you have any questions? This Kalani's question, sir, if a newly started business requests credit facilities, what should we consider and how we analyze about financial situations? Now, as I mentioned earlier, there are mainly two factors. One is the repayment capacity, the other one is the security. The security, we can ask that newly incorporate company to provide a proper security, a valuable security to the exposure, and establish the repayment capacity. Either you can take a budgeted or propose a business activity plan with a proper cash flow projected. Plus, if they have some business already started and if they have deposited money in the bank account, you can take the bank account details, and definitely you have to visit the company and take an assessment about the future of the company, and plus other factors and other risk assessment conditions you have to take into account before you taking a final decision. The conclusion here also again come to repayment capacity and the security. For even a new business or a old business, But in case of new business, you don't have a proper set of records that you perform well in the past. That aspect is a judgment or a estimate by the credit decision maker. In order to minimize your the risk probability of failing your decision, you have to get corroborative evidence such as by way of visiting there and get the control aspects in the entity, and you can ask some different opinions from others, and you can ask a list of customers, possible customers, and you call them and ask whether this particular entity have orders with them. And likewise, your judgment can be the erroneous decision can be minimized by way of having very corroborative things. Different banks have different models. Normally, all the banks provide the facilities to the people who have already money. But in case of these SME, small and medium cases, even though currently they don't have that much of cash flows, they are the people who really need these facilities. But normally the banks and financial institutes, they would like to provide the facilities or the lendings, loans and advances to the people who already have funds. But the real lendings and the real decisions come to effect when you provide facilities to the newly started business entities. Now, in this course, in future, next week and week after next, you will get realize how you assess the financial statement provided by even a newly started business entities. Right. If you don't have any questions, we'll move. Now, in the company, these things are very important, especially as per section 148. Board of directors must ensure that the company, one, correctly record and explain transactions. As credit managers, relationship managers, credit officers, branch managers, on behalf of the board, right? Now, this particular activity should be done by an accountant or finance manager or finance director and the CEO of the company, right? Since there is a requirement as far as accounting records are concerned, the responsibility is laid with the board of directors of that particular entity. But as lenders, we should ensure that correct recording and explain transaction is happening there in the entity, right? You have to make sure, right, as lenders, or get proper documents to ensure that it is correctly happening. Normally, it's very rare that you go to these places and you normally visit the manufacturing, you normally visit the factories, you normally visit their warehouses. Those things are happening, but when it comes to recording and explaining the transaction, the bankers normally go to the finance department of this particular entity or the company, or at least they should check a finance division is there, how these transactions are getting recorded, right? That is one of the important aspects. If they prepare their financial statements by taking the account statement of the banks on a yearly basis, nothing is happening at the level when the transactions are generating, and they just forget about all that finance aspect, finance and accounting aspect. They just merely take the bank statement of their current accounts and submit on a yearly basis to accountant or a bookkeeper in a separate place. That is not good financial practice. That is a kind of a point you have to make. Even a small entity, small scale business, they should have a proper bookkeeping or financing or accounting should happen there, right? Very rarely the credit managers look for these aspects when they physically visit their clients. You have to ensure that the vouchers are there. You have to ensure the proper accounting is there, whether they have used accounting this application, some software, right? You should check those aspects as well. Then, according to the section 148, financial statement should be prepared by a responsible person called CFO, who should certify that financial statement for compliance with the act, right? Now, you can download your bank's financial statement. In that bank's financial statements, the CFO of your bank certified that it is in accordance with this section 148. You go to the balance sheet of the bank financial statements, there is a signature available of the CFO of your bank, and before his signature, there is a sentence. I certified that these financial statements are in accordance with the section 148 requirements, right? Then signed and dated by 2 directors. All the financial statements of a company should be signed and dated by 2 directors on behalf of the board. Especially when you get your financial statements from a company, you have to ensure these aspects. Whether that financial statements signed by the CFO, signed by the 2 directors. There are compulsory requirements. These are compulsory mandatory requirements specified by the 148 of the Company Act, section 148 of the Company Act. Then financial position determined at any time with the responsible accuracy. Financial statements readily and properly audited by stipulated auditors. And this is also very important. Auditor should certify the financial statement. His seal should be affixed to the financial statements when you receive. Now, in these days, due to these pandemic situations, it's very difficult to get down the financial statements, but make sure at least an email get from the auditor whether these financial statements are certified financial statements. Therefore, very important that you take those things into account. First, auditor should sign and his seal should be affixed to the financial statement. Number 2, CFO should sign these financial statements are in compliance with the section 148 of the Companies Act. And 2 directors should sign and dated the financial statements. I will check on these aspects in the exam, right? Then same topic, financial statements. I took few sections of the Company Act. Section 151, every company shall prepare financial statements within 6 months of the end of the financial year or within any extended time determined by the Register of Companies. Now, according to the Company Act, every company should prepare and present a set of financial statement, audited financial statement to the Register of Companies within 6 months after the expiry of the financial year. For example, if it is 31st December 2020, you have to submit a set of financial statement, audited set of financial statement to the company register before 30th June 2021. 30th June 2021. Right. That is a requirement, right? When you analyze when you take financial statements from the company, you can check whether these things have properly happened. According to section 151, there is a requirement, right? If you have a delay, you have to get the approval or extended deadline from the company registrar, right? There are rules. Rules are for if you want to breach those rules, you have to get the approval, prior approval from the regulator. Similarly, now these days, to take the lending facilities, normally the approving authority says for lending facilities, there should be cash buildups, right? In case of an emergency, the cash buildup can be used to repay any default installments, right? But these days, especially due to this pandemic, this cash buildup thing, you cannot maintain. In that case, what you can do is, you can ask the approving authority again, explaining the current situation and where you cannot maintain the cash buildup. Ask the approving authority, since the situation does not provide us to maintain this cash buildup, therefore, can we withdraw from this particular condition at least for 6 months? Thereafter, we will implement the same in again if the country becomes normal and client also having his business in the track again, right? Even though conditions are put, you can take those conditions after referring the particular authority who have originally impose those conditions in the things. Similarly, here also there is a period of 6 months. If you cannot provide or cannot prepare and audited the financial statements after expiry of 6 months, there is a condition. You can ask this registrar of companies and ask for an extension, right? But there is a requirement, every company to prepare and submit a set of audited financial statements to the registrar of companies after expiry of the year end before the coming 6 months. Then in addition to that, an annual return must be filed with the registrar of companies along with the audited financial statement. In the annual return, not only the audited financial statement, there are other information to be filled, a kind of a return. Now, names and addresses of the directors, any changes, lot of things are incorporated in the annual return. The main one of the main part is the audited financial statements. And if you take the third point, for non-compliance, every director is default shall be guilty and liable for fine of 100,000. Right? Therefore, every year after every year end, before expiration of 6 months, you have to file this annual return with the company registrar with the audited financial statements. Section 152 provides similar provisions for group financial statements. If you have a group, if you have a few subsidiaries, then the holding company and the subsidiary become a group. In case of groups, you have similar set of provisions. Any questions? Any questions? ada ප්‍රශ්න තියෙනවා නම් අහන්න පුළුවන්. Right. Okay. Then this annual report and its content. Now, the preparation of annual report is for public companies, right? Whether that company is listed or not does not matter. But if it is a public company, you have to prepare an annual report. The particular section is section 166, 166. The board of every public company shall, within 6 months after the balance sheet date, similar to the return that we need to, annual return that we need to file with the company registrar, prepare annual report on the affairs of the company during the accounting period, right? Annual report should be sent to every shareholder. Right? In case of public company, every shareholder 15 working days prior to the date of AGM. Right? In a public limited company, every year you should have an AGM. There are different provisions applied for AGM. Before 15 working days, 15 working days, right? Prior to every AGM, you have to provide the annual report. The contents of the annual report also they describe under section 168. The company's nature and nature of business and type of business. Normally, the companies, the public companies, they will give a kind of a business they are in, and during the past year, the products that they have canvassed, the performance, every area. If you go to your bank's annual report, you can see every business sector, say consumer banking, corporate banking, retail banking, then your SME performance, treasury performance, trade performance. Likewise, in every business aspect, they will give brief introduction and the performance, the way and the things that each and every company described may differ. Some companies may put their graphs, tables, pictures, lot of write-ups. There are separate competitions for this annual report. Normally, in the country, if you take the Chartered Institute of Sri Lanka, they have a competition for annual reports. Therefore, in order to apply the report to those competition, some companies may ask for a different writer and different agency and print those annual reports, and they may go for those things. If you are a company not applying for those competitions, and if it is a normal course of business entity, then you can have a minimum set of information incorporated in preparing this particular document. But it is a very valid document, since this document is not only for competitions. If you take any potential investor, any customer, any person outside your company, if you want to get some information about your company in the previous year, the only way he can go through the annual report and get the idea, right? Therefore, the annual report has become a kind of a investor relation document where potential investors will go through the annual report and get down a lot of information from the annual report. Therefore, in the AGM itself, even though now if you take the company, the control and the ownership is different, right? As I mentioned earlier, some companies may have 17,000, 20,000 shareholders. Therefore, every shareholder cannot come and control the business. Practically, it is very difficult. Now, in a proprietorship, in a partnership, the proprietor or the partners can get involved in business activities. In those entities, the owners and the controllers of the business are same. There is no difference between ownership and control. But in case of a company, if it is a private limited company, the ownership and the controls might be the same persons because the number of shareholders very limited, right? But in case of public limited company or listed company, where you have 1,000 shareholders, you have 15,000 shareholders, even 30,000 shareholders, where all the shareholders cannot come to control the business. In that case, in an AGM, you appoint a set of people to control the business. That is, those people are called board of directors. Even the board of directors cannot control the entirety of the business because they are not involved with the business activities. In a company, the public limited company, you appoint a senior management team in order to control the business. On a monthly basis, you have board meeting. On a board meeting, you can check the performance of the management. Therefore, in a public limited company or a listed company, normally the control aspect is done by the senior management team. There is a board of directors every month on a monthly basis. They check the performance, but they cannot go into a large extent in assessing those activities. The summary of activities will get presented in the board meeting, right? But in proprietorships and partnerships, you can see the owner also controlling the business. Therefore, these shareholders also, since large shareholders are there, their main information source also the annual report. During the past year, what has happened to the company, what the senior management did in the past year. Those things will get reflected in the annual report. Therefore, even though you are a owner of a company, you are a shareholder of a company, you are also getting a lot of information through this annual report. I want to emphasize the fact that the annual report is the main document, main information document for various stakeholders who are interested in a business organization, especially if it is a public limited company. Therefore, before 15 working days prior to the AGM, the annual report should be sent to every shareholder, because in a public limited company, you have a variety, a higher number of shareholders in a public limited company. Now, if you go to the content, I discussed the first point, company's nature of business and type of business. Then sign financial statement of the company for accounting period and group financial statements. Normally in an annual report, you incorporate the financial, audited financial statement. Then auditors report on the financial statement. It should be one of the main item in the annual report. Then any change in accounting policies, all the related changes. Then particulars of entries in the interest register. There is a separate document called interest register where the directors' details and the other debenture holders' details are incorporated, the shareholder details. Any particular entries you have to incorporate in the annual report. Then I said a different set of shareholders, that is board of directors appointed in the AGM. Now, in order to have a transparency, more transparency, the things that we have paid to directors should be incorporated. Things that we have paid to directors directors should be incorporated in the annual report, especially separately. That's why remunerations and other benefits of directors, right? For board director meeting, the directors are given director fees, and there are some. If you take a bank, there are a lot of board committees. For every committee, directors get involved, and they also get paid because of the time that they spend with the board meeting. Those things, even though it is not material, there is a requirement for you to explain these things in the annual report. This is a Company Act requirement. Then depreciation provided in the financial statements. Then total amount of donation made by the company. This is very important point. Now, even though directors are allowed or senior management people are allowed to approve the donation, all the donation, if it is a 1 rupee, all the donation should be explained in the AGM, and it should be clearly given in the annual report, right? Because, for example, say in a company, if a chairman wants to give 10 million donation to his village temple, that is his own decision, and that chairman's name will get appeared in the whatever the construction in the that village temple, right? That is his own benefit, but he uses company's money. In that case, if it is a 10 million, even 10,000, it should separately explain in the annual report, and these things should get discussed at the AGA. Then audit fees and non-audit fees. If it is material or not material, every single cent paid to auditors and non-audit fees, if it is a different assignment, those things should be separately presented and approved in the AGM. Names of person holding position as directors, right? You have to have in every annual report, there is a separate section for directors. Their names, their qualifications, the previous company records, everything is described in that director pages in the annual report. And this annual report should also signed by 2 directors of the company. Right. Any questions up to now? You do have any questions up to now? What is public company unlisted? Right. If it is you can if you won't go for public issuing to ask for capital by openly asking public to contribute capital to our company. If you want to do in that way, you have to list your company as a public company. Otherwise, if it is limited to your own family members, normally those companies are called private limited company. If it is a public company, when you ask capital, when you ask the general public to contribute to your company, when general public buy your company shares in a situation where they want to liquidate those shares, there should be a market, right? If it is, if that benefit, if you want to give that benefit to the shareholders who will buy your shares, you have to get registered with the share market, Colombo Stock Exchange, right? Therefore, normally all the public limited companies will get registered with the Colombo Stock Exchange. If it is a public company which is registered with the Colombo Stock Exchange, are called listed companies. there are some public companies, even though it is a public company, it is not listed with the stock exchange, Colombo Stock Exchange. In that case, shareholders of the public limited companies, for their shares, there is no market liquidity, right? If you are registered, if your company is listed with the share market, shareholders have a market value for their shares. If they want to buy some shares. If they want to sell some shares, right? If it is a public company unlisted, that is how it is. Even though it is a public company, it is not listed with the Colombo Stock Exchange. Any other questions? Right. Before I start the next set of slides, I will give a 10-minute break for you, right? Now it's 8:40. You have to come at 8:50, right? I'll start the lecture again at 8:50. Right, okay. Right, we'll start it again. We'll go to the slides. Next one is kind of a different topic, which is also related to accounting of a company as credit managers and brand managers, credit officers, relationship managers. You need to worry about this aspect also when it comes to company, that is distribution of profits. In the Company Act, this is separately dealt with what you have to do when you distribute your company's profit, the things that you have to follow. Therefore, if it is a company, once you granted a facility, that is based on a kind of a date balance sheet and the kind of a date financial statements. After that date, if the company going to distribute some profits, distribution may attract reduction of cash. When you are to distribute some profit, normally it will be on cash. If it is on cash, the company's financial position will get reduced. Therefore, after you disburse a facility, if the company is doing a kind of a distribution of profit by way of dividend payment, you have to ensure the company has adopted the things in the Company Act and they have followed everything in line for these particular distributions. Now, the coming slides will discuss on the dividend distribution, the things that a company should follow before a dividend declaration and payment of dividend to its shareholders. First point, the board of directors are required to always be mindful and conscious of the solvency of the company. Here the point is, if the company is solvent, only a dividend distribution can be done. An insolvent company cannot distribute dividend. There are sections prohibiting them to do that. Right, we'll go through one by one. The concept of distribution in terms of act consists of two things, that is transfer of cash or property other than shares of a company, then incurring a debt or any other benefit on behalf of the shareholder. That is, if you take the summary of these 2 points, company will pay something to the shareholders, right? Whether it is cash or any other way, the main points by way of distribution are listed below. When considering the shares held by a person, the distribution includes dividend payment. The main point is the dividend payment. Then kind of a redemption of shares. The portion of the shares will get redeemed. That is also a hit for the bank, because once you approve a facility, you approve the facility based on the shareholding or the value of stated capital. If the company, by way of redemption of shares, if they have reduced the stated capital, there is a kind of a risk on that particular activity for a lender. Therefore, that is also very important. When you put conditions in the offer letter, these things will have to take into account when you drafting offer letter. Reduction of shareholders' liability, distribution of indebtedness, that is debentures, redemption of shares amounts to reduction of capital, a special resolution to such an amount the directors think appropriate. Public notice shall be given at least 60 days before a resolution. No need to obtain court sanctionation. Those things, since there are possibilities of reduction of capital, dividend payments, any redemption of shares, right? These points should be taken into account when you are drafting your offer letters to customers before, because after you grant a loan, you grant a loan based on some assumptions, right? Say you have this 60 million of stated capital. You have retained profit of this much. After you disperse the facility, if those equity items, especially the equity items, the stated capital, retained profits, reserves, those things, if they are reduced after you grant in the loan, then the recoverability in case of a default will be in a question. Therefore, in order to avoid those instances, when you approve your facility papers, when you give your offer letters to customers, there should be some conditions to cover even in the loan agreement or in the offer letter. Right. I just want to emphasize these points. I am not going to explain in detail. Then when it comes to solvency test, right, there is a requirement before a dividend declaration. You have to perform a solvency test, and it should be done by an external auditor and independent report. Before dividend declaration, you have to have this document. In terms of section 57, in determining whether the company satisfied the solvency test, the board shall take into account the most recent financial statements prepared in terms of section 151, the circumstances the directors know or ought to know which affect the value of companies' assets and liability, then a fair value or other method of assessing values of the assets and liabilities. Normally, this solvency test will be conducted by the external auditors. These are the two criteria to determine whether company is solvent or insolvent. First one is number one, your ability to pay debts in normal course of business. The first conditions, there are two conditions before you pass a solvency test, all two criteria should be met, not only one criteria. First criteria means current assets more than the current liability, very straightforward criteria. The point here is your ability to pay debts in normal course of business. In short term, if your current assets is more than the current liabilities, you pass the test number one. Then number two is value of entities, assets less liabilities, stated capital and proposed dividend. Here the point is you should have a adequacy reserves to declare dividends, right? Adequacy reserves to declare dividends. If you go to the formula, total assets more than total liability plus stated capital. The missing item is the reserves. Therefore, normally, if you add total liability plus stated capital plus reserves, the equation will be that both sides will get equal. The second point, the emphasis is you have to have adequate reserves to declare dividends, right? If you don't have the adequate reserves to declare dividends, then you will get fail in the second criteria. The both criteria should be passed to pass the solvency test. First one is the current assets more than the current liabilities, very straightforward one. Then the second formula, second criteria is you should have adequate reserves, right? In order to establish that, the formula is total assets should more than the total liability plus stated capital only, not the reserves, right? If it is so, if the criteria meet the second formula, that means you have adequate reserves. Right. If you have any questions up to solvency test, please ask. If you do have any questions. Now this solvency test may be tested in the exam. If you do have any questions, you can ask. Right, okay, we'll move. Right. Next part is understanding the client's business. This is also very important, very important when you, before you perform a financial statement analysis, you should understand the client business, right? If you don't know the client business properly, the things stated in the financial statements will not properly analyze and properly interpreted, right? Therefore, this is kind of a very important thing, especially if you take the hotel industry. If you take the hotel industry, if you don't know occupancy, what is occupancy ratio, it's very difficult for you to analyze the financial statements. If you are in a say state industry, say this tea manufacturing, if you are analyzing the financial statement of a tea manufacturing, if you don't know the words, say nurseries, right? Those are some technical words. Some industries do have different names. Now, since you are in the banking industry, you know the meaning of non-performing, right? Cost to income. Right? If you are not in the banking industry, if you are doing an analysis, you have to get some knowledge in the banking industry first, right? Now, hands-on experience somewhat matters because you are taking a credit decision. You are granting your deposit holders money to these clients, right? That's why we at the outset we said when you analyze your financial statements, you have to have a kind of a background on the industry to which that you expose your customers' money. Right. Point number one, knowledge of client's business is necessary in the process of analyzing the credit worthiness and to assess the level of risk involved. Now, if you take some industries, there are different risk involved. Now, currently, if you are in the hotel industry, a different risk, right? You take the last 3 to 2 years, the adverse affected industry is the hotel industry, tourism. This Easter bomb attack in 2019. From that onward, initially government granted a moratorium to the tourism industry, but thereafter when come this COVID-19, right? We thought COVID-19 is will be completed or will be finished in 2020. Then it proceeds to 2021. Now our hope is this will be finished within this year, and we have a better 2022. But there is a question, right? If you take tea industry, there are a set of different risks involved, right? If you take education, if you take hospitality, if you take this construction industry, there are separate set of risk involved. Therefore, understanding your industry to which your client belongs is very important when you analyze a financial statement. Now, for this matter, in order to accommodate this kind of different industries and different risks associated with different industries, most of the banks, especially at the corporate level, they have segregated different industry specialization areas like bank and finance, like construction, tourism, education, hospitals, right? Trade, right? You have a separate set of relationship managers, and all the facility belongs to a particular industry will be allocated to that particular relationship managers. You have a separate sector-wise specialized relationship managers at corporate level. This cannot be done at the retail level, but to mitigate different risk associations, different problems, different criterias, different conditions, in order to address those things, especially now the current trend is you are having separate sector-wise relationship managers for different industries. Then if you take all the telecommunication industry facilities will get handled by a single RM or same sector, right? Therefore, getting an understanding at industry level before you analyze a financial statement is utmost important. Then under that topic, essential components are business background and nature of business. We have to have a good business background and nature of business. Then macroeconomic factors sensitive to the business. you have to get an understanding on these two aspects. And normally, to get an proper understanding, you can read, you can download, you can ask questions, you can send a questionnaire and get answers. Those things are very important. But the most important thing is to visit their places. Visit their places, right? Now, in 2019, there were a lot of cases relating to a lot of leading banks relating to the pledges of paddy, right? You grant your loans against the warehouse paddy, whereas you have under lock and key, one key is with you, but you have to visit these places, these warehouses, paddy warehouses on a quarterly basis. Whereas if you open the door in the warehouse, you can see it is full of paddy bags. And if you go to the back door, there also you can see a lot of full of paddy bags there. But when you actually visit the place, if you go to the middle part of the warehouse, there is nothing inside, right? Lot of banks, leading banks in 2019, they have come across these kind of paddy pledges, and they got to realize that there is no security for their facilities. They have to provide for all of those facilities. Therefore, it is very important that you visit those places. The point here is to get an understanding, not having telephone conversation, not having email conversation, but you should visit these business places. Then point number 3, product service quality, marketability, and trading outlook. You have to get some understanding on these aspects. All these things are covered under understanding the client business. Before you analyze the financial statement, you should understand, you should get understanding on the client's business, because whatever they do finally will get reflected in the financial statements. If there are items, now say there is a closing stock item, right? Say 100 million. If you visit there only, you can see whether there are 100 million closing stock. It is even though there is item in the balance sheet, say 100 million, but when you physically go there, there are no items. It's only about 5 to 10 million. In that case, in that ground, you can ask the particular accountant, particular finance manager, or the production manager, where is your balance closing stock, right? Therefore, the physical presence will take, by and large, a very important when you assess the or when you want to get an understanding of the client business. Right. Then I have already discussed this, the definition of financial statements. The objective of the financial statement is to provide information about the reporting entity's financial performance, financial position, that is useful to wide range of users for assessing stewardship of the entity's management and for making economic decisions, right? I have said 3 things in addition to this definition. What is there? Financial performance, financial position, plus cash flow, right? To make decision by the interested party, you have to provide all these informations via the financial statements. That is their objective. When you prepare the financial statement, there are set of guidelines issued by Institute of Chartered Accountants of Sri Lanka. If you go to this Act 1995, Accounting and Auditing Standard Act, in that act, all the powers were given to Institute of Chartered Accountants of Sri Lanka to implement accounting standards in order to prepare the financial statements. Now, when accounting standards are prepared, they take the international accounting standard into account. This is a set of guidelines prepared by Accounting Standard Board, International Accounting Standard Board, to be adopted in preparation of financial statements. Normally, Sri Lankan accounting standards are based on the international accounting standard. There are some deviations, especially when you adapt those things into the country. There are some deviations, but if you take the substance, our accounting standard and the international accounting standards are more or less similar. Then Sri Lankan accounting standard, SLAs. Now these accounting standards are called LKS, Lanka Accounting Standard, and SLFRS, Sri Lanka Financial Reporting Standard, as I discussed last week. This is a set of guidelines prepared by Institute of Chartered Accountants of Sri Lanka based on IAS. IAS means International Accounting Standard, modified to suit our local requirements and law. I already mentioned the particular act gave powers to Chartered Accountants of Sri Lanka to prepare this accounting standard. Sri Lanka Accounting and Auditing Standard Act number 15 of 1995. This was passed in Parliament to implement provisions in the preparation of financial statements. Now, what we do here in Chartered Accountants of Sri Lanka, they have a separate committee called Accounting Standard Committee, which comprise bulkly from the set of chartered accountants, plus company registrar, plus representative from Ceylon Chamber of Commerce, Federation of Chamber of Commerce, and representative from SEMA, representative from Central Bank of Sri Lanka, any other persons which are relevant to particular accounting standard. Their role is this accounting standard committee role is to implement new accounting standard or to abolish the old accounting standard which is of no use currently, or make provisions or make instruction to amend the existing accounting standard if it is required. Once these things are done, it will go to the Council of Chartered Accountants of Sri Lanka. Once Council approval obtained, it will go to the Parliament. Right? In the Parliament, after passing these new regulation, it will become part and parcel of the Sri Lankan law. Therefore, every entity, if it is law, when they prepare the financial statements, they have to follow these law. Therefore, the point we can take there is when companies' financial statements are prepared, you have to check whether who prepared the financial statement of that company. Who prepared the financial statement of that company? If it is a qualified accountant or there is no qualified accountant there to prepare the financial statements. Then who audit the financial statement? The second questions, right? Therefore, that assessment from your side, it is needed. If you can recommend the company to have a qualified accountant to prepare the financial statement or strengthen the finance division of that company, that is for the betterment of the company as well. If it is a company or an entity who just merely get the bank statement, and on a yearly basis, they will go to meet an accountant and prepare the financial statement based on the bank statement. There is no process of collecting accounting information. There is no process of recording or classifying or summarizing or analyzing or whatever the interpreting. There is no proper accounting methodology establishing the entity. That is a very risky thing, right? If you want to have a proper information for you to analyze, you should have a proper mechanism at the original points, that is at the business entity level, to get those information. Otherwise, the accuracy of the information in the financial statements are of questionable, right? If the client used to get the bank statement, monthly bank statement, and take those 12 bank statement on a yearly basis to accountant and prepare based on the bank statement, those accounts cannot be relied upon, right? Therefore, what is important is credit plus something from your end. It will benefit yourself as the bank and for the client as well, right? When you have a poor financial recording mechanism incorporated in the client level, it will affect by and large in the business as well. If the Inland Revenue Department issue an assessment, these people, these proprietors, partnership, even the company, private limited companies, they go behind the Inland Revenue Department people. If they might try to give some bribes and take off those assessments. That is how they have used to do these kind of things. But in long term, all of these things, when the company becoming more and more large as far as the business activities are concerned, you cannot accommodate those things. There should be a proper way of collecting data, recording data, and preparation of financial statements in the company level. Therefore, it is very important in that aspect. You have to have a proper accounting methodology, proper accounting process for every client, whether it is big or small or whatever it is. From bank's point of view, make sure that it happen. If it is not there, it will happen on a periodic basis. Give the client some instruction. Give assistance to find a proper accounting firm at least, or give some assistance to provide the part-time qualified accountant to these people. For these people, you need not to spend a lot of money, right? If you are an undergraduate, you can do a part-time accounting job. For those people in university, you have to on a monthly basis 10 to 15,000. They will take and do that job. Very easy. What is important is to start the collecting recording process at the business level. After that, you can see the progress. That's why you need to go there and see whether proper collecting recording is happening at the business level. Then from 1/1/2012, that is January 2012, I have discussed these points last week as well. A new set of accounting standard implemented, that is a material change in the accounting arena in Sri Lanka. The date is 1st January 2012. It is 9 years ago. The old accounting standard, that is Sri Lanka accounting standard, it was replaced by Sri Lanka Financial Reporting Standard, that is SLFRS, and Sri Lanka Accounting Standard or Lanka Accounting Standard, LKS, right? Now, from 1st January 2012, all the accounting standards are known as Lanka Accounting Standards or SLFRS, Sri Lanka Financial Reporting Standards. Right. The similar slide repeated. Right. This was previously discussed. Complete set of financial statement according to SLFRS LKS comprised of the following. That is statement of financial position as at end of a particular date. Then statement of comprehensive income for the period. Then statement of changes in equity for the period. Statement of cash flows for the period. Notes accompanying of the accounting policies and explanatory information. Right. Any questions up to now? if it is a private limited company, IRD have rights to sue the company on behalf of a director, non-payable of any tax. Yes. Now, if it is a private limited company, the tax liability of the company will be of the company side, since the company has a legal identity. Inland Revenue Department can sue against the company, not against the director. If the company is in a not in is if the Inland Revenue Department cannot recover it from the company, you can go to a director level. But normally they will sue against the company initially, because the company has a legal identity. Even though these private limited companies, it is like proprietorship or partnerships. Even though it is the name is a company, only the family members are the owners. The directors are father, mother, their sons or daughters, right? That is a family-owned business, right? Even though the name company is there, you can see very poor financial discipline is there. Now, if I recall an example, it's very reluctant. They used to do their business in the same way. The only thing that they have changed their name or converted their business into a family-owned proprietorship partnership into a company. That is the change, but the way that they are doing business is similar. When I was an undergraduate, I used to go for a part-time job that is for a company that is a polythene manufacturing company situated in Dehiwal area. Now they are becoming they have become number 2 in the Colombo district. They all if you name all the companies in Sri Lanka, they are providing various products to those companies. If you take biscuit companies, they are providing. If you take tea exporters, they provide different products to those companies. Now, when I started the job at on a part-time basis, it's very difficult them to convince the requirements as because the last thing they worried about the accounting part. As I mentioned earlier, they used to take the 12 months bank statement on a yearly basis and take those statements to a partly qualified accountant at Kadawat area, and they hand over those 12 statements before November, say in between June to September in a year, and most probably on 25th of November or 20th of November, they go to Kadawata and they see their financial statement on that day, and without any question, they sign, and if there are a small tax payment is due, they issue a check and they pay the payment of that partly qualified accountant, and they come home, right? But one day, this particular company received an assessment from the Inland Revenue Department, say you have not paid these you in the bank statement. We can see a lot of income is there, but in your financial statement, very small amount is reflected in the income statement, and you have failed to pay this amount of taxes from last 5 years, and there is a charge also. They received an assessment to pay millions rupees. Even though their business is good, they were like providing information last moment, as I mentioned earlier, going to meet the partly qualified accountant on a yearly basis with their 12 months bank statements last day only they see their financial statements. What a pathetic situation. They only see their financial statement after the year end, after expiry of say 9 months, and before submitting to the revenue department, they only see months, right? They have not asked any single questions because it is prepared on that moment. No? They don't have any question at all. They just forget about the financial statement. They even though they are the owners of the company, they do not want to even see the financial statements of the company. They don't know about the income. They don't know about the things in the financial. They didn't take into account those information when they do business. That is how the bulk of the SMEs, bulk of these private limited companies, businesses are managing their business. They take their own decision, not only the financial statements, not based on the financial statement. Then when came me into the picture, I used to record all the transactions, right? We prepared monthly financial statements, and the one thing I forget to mention, then they received that assessment from the revenue department to pay millions of rupees. The particular partly accountant, he took that person, businessman, to a different senior person. And what is the reply to the revenue letter? When I received this particular letter from revenue department to pay millions of rupees, I had a heart attack and I got admitted to this so and so called hospital. Therefore, please withdraw this assessment from your side. That is very meaningless reply to the revenue department, right? That is how they react to the react with the authorities. Then in revenue department, they didn't took off their assessment. Then they try to, this particular businessman with the company with the that partly qualified senior accountant, they try to contact persons from revenue department, try to give some bribes to those people and take off the assessment, right? I can't remember whether they took off or they might have given some period to pay taxes on a part. They were like failed to find people from revenue department to take off those assessment, and finally they revenue department required these people to pay the additional taxes on a monthly basis for 2 or 3 years, right? Then I introduced this monthly accounting concept. They have realized the information that I am providing to make decision. Ultimately, I also found a good chartered accountancy firm. I asked the owner to withdraw from that partly qualified accountant. He is like taking money from these people. When that partly qualified person's sons going to a foreign country, these people, these businessmen sending their vehicle, own vehicle to that partly qualified person's home for their traveling purposes. He is the main person in the drama because these people, they don't have any accounting knowledge, right? Whatever the things that they, that particular partly qualified accountant asks, these people send because they are totally rely on this person, right? For what? Nothing, right? They don't get anything from that person because nothing from the accounting side, right? Only issues, only taxes to be paid, only letters from or assessment from the revenue department. That is how these small scale business people or SME or private limited people, they don't have any knowledge on the accounting aspects, right? Then the picture totally different. After I went to this company, we prepared the monthly financial statement. We actually acquired the software and implement and when the transaction is done, that captures into the system and automatically financial statements are prepared. And we used to present our monthly financial statement to the board meeting. There were regular board meetings, even though it is a family company. And a lot of things have changed. And I managed to change the auditor, and I found a good chartered accountancy firm in the Delkand area, and we changed that auditor also. We forget about that party qualified accountant. We have now the monthly financial statement. These monthly financial statements are provided to business decisions. Now, if you take this company, now they have in a good position. They are not worried about letters. They are not even receiving letters from the internal department. All the transaction in the bank statement are reflected in the financial statement, and financial statements are prepared based on the accounting information collected on a daily basis. There are different sources for the financial statement preparation process, and once the information is prepared, it will also be sent to different users to take decisions. Right. Any questions? Right, okay, we'll move on. Then item wise, there are 6 components. We'll first take the statement of financial position. Normally, in a statement of financial position, we give our assets, liability, and equity position. There are 5 items, I said: income, expenses, asset, liability, and equity. Income and expenses will go to the income statement, and asset, liabilities, and equity balances will get reflected in the statement of financial position. In a vertical format, first we'll describe about the assets of the company. First items are non-current assets. We discuss long-term assets, which will give long-term income to the entity. Then long-term investments. Then investment with more than 1 year maturity, investment in company shares, right? Then you have current assets. Under current asset, mainly you have inventory or stocks, then trade receivables or say debtors, less provision for bad debt, then prepayments, cash and bank balances. Under other side, that is liabilities and equity. We take liabilities, first equity part, shareholders equity and reserves. Under that, stated capital, reserves, retained earnings in a company. Then non-current assets, long-term loans, debentures, retirement benefits. Under current assets, accrued expenses, taxes, payables. Right. In a normal business organization, these are the items in a statement of financial position, previously known as balance sheet. Assets and liabilities and equity items. Right. Any questions from balance sheet or statement of financial position? If you do have any questions, you can ask. If you are dealing with groups, you should have 2 columns for the holding company and the group column, right? If you are dealing with companies, you have to have a kind of a background knowledge on how consolidations happens. I don't have any time to discuss those things. There is a account called cost of control account. You take all the liabilities or the equity part into cost of control accounts and compare it with the investments, and you eliminate certain items, and those things need to be a fair knowledge you have to have when you are dealing with holding company and consolidated or group accounts. There is a separate accounting standard for that as well. I mentioned last week there was a question raised by one of my friends who is actually one of the corporate departments. One of my friends raised about some question with regard to the equity items in the consolidation financial statements and the holding company financial statements. If you do not have a fair knowledge, please ensure that at least you contact a person in the finance department or internal audit department, a chartered accountant in your bank to get fair knowledge on the before you making a decision, right? It's very important. The answer my friend had for that particular question is totally different when I explain him the actual scenario, and his subordinates were like they have not realized the things in the consolidated balance sheet and consolidated income statement when they actually originally analyzed the financial statement of that particular group. Therefore, if you do have any questions, if you don't understand anything, if you do not have any answers for some questions, please contact finance department people. They may give some help to identify, because they do have a proper accounting knowledge than you. Right, then we'll move on to the next slides. This is comprehensive income statement. Last week I mentioned comprehensive income statement have two parts. You can have separate accounts for those two parts or separate statements. First statement is the income statement. Second statement is the other comprehensive income statement. If you take the income statement, normally in a normal business, you have sales, then you have to deduct the cost of sales. Then in gross profit, you have to add other income. Then you have total income. Then under expenses, you have to deduct distribution cost, expenses relating to administration, expenses relating to finance or other expenses. Then you have profit before tax. Then deduct the taxation. Then you are end up with the final figure, that is profit after tax. That is the end of the first part, that is income statement, last item, profit after tax of a company. Then when you go to the second statement under the comprehensive income statement, that is other comprehensive income statement. Other comprehensive income statement, the starting point is the net profit after tax, right? Net profit after tax. Normally we take for the other comprehensive income statements the income and expenses which are of a capital nature, right? Which are of a capital nature, and there are some standards instructed for you to take those items under other comprehensive income statement. Those are very technical. Therefore, normally for the time being, you think that these items are of a capital nature. Now, if you take the revaluation surplus or reversal, that is a capital nature item. If you do have a building, land and building, which was acquired 5 years back, now the value is more than the original value is 1 billion. Now it is 1.5 billion. In that case, you can have a capital gain of revaluation gain of 500 million, which is considered as a other comprehensive income, not the normal income and expense will not go to the income statement. will not be part and parcel of the normal profit after tax. That's why it is treated or it is incorporated in net profit after tax as a revaluation gain or loss. If you do anything to the other comprehensive income, any entry to the other comprehensive income, the corresponding entry should go to the changes in equity also, since this is a equity part. Right. Any questions? Any questions on comprehensive income statement? Comprehensive income statement, any questions? Right. Then the next statement is statement of changes in equity. I already mentioned equity of a company comprised of two items, that is stated capital plus reserves. Right? Stated capital plus reserves. Equity of a proprietorship means a capital account. Equity of a partnership means capital account plus current account balances. Then equity of a company includes stated capital plus reserves. If you take the reserves, there are a number of reserves: general reserves, retained earning, revaluation reserves. Different kind of reserves can be there. All together will part and parcel of the equity, reserves plus stated capital. In this statement, the movement or changes from the balance at the beginning of the year to the balance at the end of the year of equity items are shown. Now, the name suggests the content of this statement: changes in equity. Right? The statement will start with the beginning balances of stated capital and reserves. And the next part will talk about the changes incorporated to the items mentioned in the equity statement of changes in equity. Right? If you have issued shares, your stated capital will increase. If you have transferred some things to the reserves, those things will get increased. Normally the profit of the year will come to the retained profit as a reserve. If you declare some dividends, your retained profit will get reduced. Likewise, all the changes we have to incorporate in the second part. Finally, at the end, the final end balance should be there. Equity items will include stated capital, capital reserves, and revenue reserves. In the revenue reserve columns, balances of retained earnings brought forward from the previous year, current year comprehensive income, transfers to reserve, revaluation reserves, and dividend payments will be shown. Right? This is also very important statement for you to get an understanding what was the balance at the beginning of equity items and the changes incorporated, and what is the end balance in the equity part. Equity means stated capital plus reserves. Any questions from equity statements? In changes in equity statement, how to record revaluation gain. There is a column in the revaluation reserve in the equity statement as a reserve. At the beginning, there should be a balance. If in a given year there is a gain, that reserves will increase. Say revaluation reserve at the beginning 200 million. I took the example where 500 million revaluation gain is there. At the end, 700 million revaluation gain should be there. The normal double entries, you have to debit that particular asset. If it is a land or building, you have to debit that asset and credit the revaluation gain. It will be recorded in the other comprehensive income and equity statement also. Changes in equity. Any other questions? Right, we'll move on to the next part. This is the format. One person asked, how do we record in the statement of changes in equity? In this column, this revaluation reserve column, right? We have a beginning balance, and here from comprehensive income for the year, if it is a gain, it will be added. If it is a loss, it will be deducted. Then balance end of the year will get reflected here. If there are transfers between these reserves, you have to use this column, transfer from reserves. Yeah. For example, say there is no general reserve. If you transfer some money from retained earnings to general reserve, you have to deduct here under retained earning and plus item in the general reserve. Right. Next, one of the important component, that is statement of cash flow. As credit managers, branch managers, relationship managers, you are very conversant with the statement of cash flow. I don't know whether you are getting this cash flow statement in the format which is prescribed in accounting standard, but you may also get some information as cash flows from the client. But make sure it is in accordance with Lanka Accounting Standard 7. There is a separate accounting standard for cash flow, Lanka Accounting Standard. Now, here getting this statement from your client is very important, right? Cash flow means if you take sometimes even the profit is there is a very minimum level of cash flow in the company. Profit is an item which you calculate, which you accounted based on the accrual concept. Accrual means when it comes to income, whether that income is received or not, if it is for the year, you take into account. For example, if you are a financial year ending 31st December, if you have credit sales on 30th December, you took those sales as for the, say, 2020, not for 2021. Even though cash is not received, we take that credit sales as income for 2020. Similarly, when it comes to expenses, even though you have not paid the expense item in cash, based on the accrual concept, since if it is falling for a particular year, even though it has not been paid in cash, you take that amount also as an expense. For example, when your accounting period is ending 31st December 2020, the December electricity bill 2020 normally will get received in 2021 January month. And you might pay that December bill, 2020 December bill in February 2021. But we know for sure that expense, electricity expense, December electricity expense that we use to generate 2020 income. Right? Even though we pay that bill in 2021. Under accounting, there is a concept called accrual. Every income and expenses, if it is not received, if it is not paid, even though it is not received or even, it is not paid, if it is for the particular year, right, we have to take that income or expense. Therefore, normally our profit, we calculate based on the accrual concept, which is different from the cash concept. Therefore, your profit cannot be considered as cash profit in a given year, right? In that sense, you do have profit, but your cash flow might be in a difficult position. What is important is you have to get a cash flow also prepared from your client in order to establish the cash position of the company. There can be profits, but there are some cash difficulties. Now you can see some companies, even though they have profits, they may not declare cash dividend because they don't have any cash to pay off the dividends. Therefore, what is important is get a cash flow statement prepared and take those statements and on a frequent basis, you have to get the cash flow statement from the client. Right. This statement provides information about the cash receipt and cash payment during the accounting period. This also helps us see how financial position changes during the accounting period. Only statement that collects and shows in one statement the causes of changes in cash during a financial period to the end. The statement will show the company's cash position at the beginning and the company's cash position at the end, and throughout the period, what has happened to the cash position of the entity under three headings, that is under operating activities, under investment activities, and under finance activities. Any questions on cash flow statement? Are we debiting revaluation reserve account or revaluation loss up to the available credit balance? Yes. If there are revaluation losses, you have to debit the revaluation loss. The particular asset need to be credited and debit the revaluation reserve account, right? If there are, if say the particular credit balance is not adequate to debit the balance amount, there is a trigger point where you have to under other comprehensive income, there is an option for you to debit the additional part of the P&L, which is very technical. I don't want to discuss here, but normally if it is more than the credit balance available in the revaluation reserve, you have to debit the P&L initially, and subsequently if there are revaluation gains, you can again credit the P&L, right? If you take the revaluation part, normally it is dealt in other comprehensive income. Normally we don't touch the P&L, but if you originally have a revaluation gain, then subsequently you have a revaluation loss, and the gain already recorded in the reserve is not sufficient to accommodate the loss. In that case, you have to go to your P&L, and after debiting the P&L in a subsequent year, again you have a gain, you can reverse that P&L debited amount, and the balance part can be again recognized in the revaluation reserve. There is a technical part, but for the moment, the maximum up to the credit available in the revaluation reserves. If there are additional debit, you have to debit in the P&L, but there is a chance for you to reverse that amount in a subsequent revaluation gains. I hope I have answered your question. So, do we get a company accounting sum for the exam or only the theory? No. You will get a company account for the financial statement analysis. Theoretical aspects also will be discussed in the exam. But I am giving instruction that nothing will be tested apart from what I am discussing here. It only will be confined to what was discussed in the these 4 sessions, and your exam will be, as far as your exam is concerned, if you clearly participated for these 4 sessions, it is not a difficult thing to pass the exam, because I am also giving a specific instruction, and I am also trying to pass you all people from the exam, but unfortunately there are people who are trying their level best to fail the exam, right? Therefore, don't put into yourself into that category. If you continuously participated for these 4 sessions, definitely it is very easy for you to pass the exam. Right. Next week we will discuss the company accounts in detail, the things that going to be tested in the exam. Right. Don't worry. Definitely it will be a company accounts for the exam, not the proprietorship or partnership accounts for the evaluations. Right. We'll move on. Then the final item is accounting policies and accounting notes. I have already discussed accounting policies. Different companies may have different accounting policies. It is very important for you to get the whole set of financial statement from the clients. Read all the accounting policies also. In the accounting policies, they may say we depreciate our motor vehicles on straight line basis at 20%. Another company may say we depreciate our motor vehicles on reducing balance method at 10%. Right? What is used when prepare accounts, the bases, principles, estimates, everything, judgment, everything is listed in the accounting policies. Therefore, it is part and parcel of the financial statements. You cannot forget about the accounting policies. It's very important. Take time and ask your subordinate to read out the accounting policies and take whatever the important points they are in the accounting policies. There are some smart accountants here and there. They might use different language and accomplish their objective via even in the accounting policies as well. Therefore, it is part and parcel of the financial statements. It is very important for you to read whatever the things mentioned in the accounting policies. You can get a better understanding. The principles and the judgment estimates are there in the accounting policies, and based on those things, they prepare the financial statements. The notes to the accounts also, notes indicate the breakdown and detailed analysis of items appearing in the main statements. That is also very important. You go to the notes and get whatever the additional information. If you feel feel free to ask any questions from the particular finance manager, particular accountant, if you do have any doubts. It's very important that you read accounting policies and accounting notes as well. Right. Any questions up to now? For today's presentation is over. If you do have any questions, I can answer now. Otherwise, we'll finish for today. I do not want to disturb you with the next week. Very important announcement. Next week, I won't come for the lecture, right? It will be a normal time, that is 8:30 a.m. Week after next, I will again come to the lecture. Then it will be 7 a.m. right? The next week lecturer also will announce the time. It will be 7 a.m. right? Next week there won't be any lectures from me. You have other lecturers come in, and he will discuss this at 8:30 p.m. Whatever the topic, right? Week after next, I will come at 7 a.m. If you do have any questions, you can ask now. Week after next, when I will discuss all the ratios, what is important for the exams, and we will calculate and discuss everything there. The final week we will discuss the past papers, and I will allocate sufficient time to discuss the past papers. Week after next, it will be it will be for ratio analysis. Therefore, your presence is very important. Next week, I am not going to deliver a lecture. Week after next, I will come at 7 a.m. right? Next week, it will be 8:30 for you to have the lecture, right? If you don't have any questions, can we adjourn the lecture? What is this question? Can we review the comprehensive income components? Now, if you take this comprehensive income statement, I said two parts. First part is the income statement. The end result is the profit after tax, where normal income and expenses will go, right? Then the second part is other comprehensive income statement, where normally we put or we record all the capital nature income and expenses like revaluation reserves. When you record something in the other comprehensive income, it will definitely should record in the changes in equity statement. There are some accounting standard adjustment also, especially incorporated in the other comprehensive income, which is very technical. Since I don't have any time, because if you take those items, I have to educate on the SLFRS 9. And the SLFRS 9, there are financial assets, there are financial liabilities. Under financial assets, there are three categories called financial assets at amortized cost, financial assets at fair value through profit and loss account, and the third category where financial assets at financial assets at fair value accommodated under other comprehensive income. Any changes in the financial assets of those categories, the number three categories, that is financial assets at fair value through other comprehensive income, any fair value changes should be come into the other comprehensive income statements. For example, if it is a company, they have a long-term investment, not for short-term selling of the shares, but for a long-term purposes. If they categorize that investment as a financial assets at fair value through other comprehensive income, the market value of that investment, if any increase or decrease in the market value, should come to the other comprehensive income statement. those are very technical stuff. In a single moment or in a 1 minute or two, we cannot explain. You have to have a knowledge on the financial assets, financial liabilities, and the asset categorization. Those things need to be discussed. Solvency test, there are two criteria. First one is your you have to have more current assets than the current liability, right? Normally you do a solvency test if you want to have a dividend declaration, right? It should be done by the external auditor. Before board declaring any dividend, they want to perform a solvency test done by external auditors. First criteria is you should have more current assets than the current liabilities. Second point, you should have adequate reserves. Adequate reserves. If you do not have adequate reserves to declare dividends, the second point, you are failing. Therefore, to pass the solvency test, you have to pass those two items. That is, one is your current asset should be more than the current liability. Number two, you should have adequate reserves. If there are no questions, we can. Yes. Sir, in cash flow statement, do we have separate calculation for operating, investment, and financing? There are no separate calculation. Every cash inflow or every cash outflow, you should categorize under these three categories. For example, if it is a normal sales or purchases, those are coming under operational activities. When you receive cash from debtors, that is coming under operating activities. When you acquire land, that is a cash outflow, that is coming under investment activities. When you obtain a loan, that is a finance activity, that is a cash inflow. When you repay a loan, that is again finance activity, but it is a cash outflow. Yes, if you have any question, you can ask. This Tishan Abegulwardhan. You can unmute your mic and ask the question. Or you can text it. Right. Again, I am telling next week I am not coming for lectures. Week after next, it will be 7 a.m. again.